last 1 year, we have seen the interest rates hikes globally as the central banks battled runaway inflation and fears of recession were also there. And interest rates today are near their recent peak levels. We are getting to see so many headlines across the globe, but making that debt and the investing instruments like gold highly attractive as well is what we have seen in the recent scenario. So the big question is, how should investors approach the markets when interest rates are near their peak levels, and what are the strategies that investors must adopt to get the most of their portfolio? Let's answer all these questions with Mr. PV Subramaniam, who is the CEO at www.subramani.com. Hi, very good evening, Mr. Subramaniam, and once again, it's great to have you onto the show. Firstly, because now what we are getting to hear is that in the past 2 to 3 years, we have seen across the globe, across the central banks, they have been taking the rate hikes. But now the commentary suggests that there could be a pause. In the US, it's still uncertain, but in India, in the recent times, we have seen RBI taking a pause. So just wanted to know your understanding onto the rate hike expectation going ahead, and in context to that, what is the outlook on the equity investments? Because in the past 2 to 3 years, that was actually a strange behavior, I would say, in terms of the relation we have seen in the past with interest rates and equities. They have been correlated in a negative sense. So going ahead, if the interest rates fall, what is the outlook on the equity investments?
Hi, Shruti. Long time no see. So let me start. So interest rates in US are likely to remain there or maybe go up. Let's ignore it for a minute. Indian interest rates may not go up too much, but even if it remains here, I don't see it coming down too quickly. So it might remain here or go down, but it will go down slowly. So the first strategy for any investor is to repay the home loan, if any, right? If you have a home loan and you have money, makes sense to repay that. Second investment option would be to put into long bonds, right? Gilt or any 2052 maturity or 2042 maturity kind of bond fund, because you're likely to see an appreciation the minute interest rate goes down. If you still want to put money in equity, which should be your third priority, is to stagger it a little bit, because we do not know how interest rates are going to move. But if you have a clear 10-year, 7-year kind of a view on equities, you can enter equities. But entering equities for a 3-4 year time frame does not make any sense. Perhaps you would make more money in investing in a long debt product, because you will get a coupon rate of about 8%, and when the interest rates fall, you will get capital appreciation. So right now, I would stick more to debt. And if I must be in an equity, I will go for something like a balance advantage fund rather than a pure equity fund.
Okay, but Mr. Subramaniam, when you say that must be in a debt at this point in time, because we have seen a lot of investors getting attracted to all these debt instruments. So once again, you are backing for the debt instruments, and in that, if yes, then what exactly, what category they should be looking at?
Okay, two categories. One is if you want to lock in your money for a long period of time without any fluctuation, then anything like if you're a senior citizen, that or national savings certificate for 7-8 years, you can get locked in at good rates, 7% plus 7.5% kind of a rate. But you can also invest in a gilt fund where you will be getting that 7.5% kind of a rate. Plus, there will be appreciation when interest rates drop. So all these three, any gilt fund with a long duration, say 7-8 year kind of duration, or a national savings certificate, or an RBI bond, even an RBI bond fluctuates. So national savings certificate or a gilt fund, that's where I would stick my neck out and put my money. And of course, my first priority would be to repay any housing loan that I have. If I have a long duration to go for it, I'll get rid of it, then I will start investing. So priority wise, first repayment of loans, if any. Second, debt funds, long debt funds, gilt funds, etc. And thirdly, I would go into an equity on a SGP mode rather than putting a lot of money, because the market could fluctuate with interest rates changing. Because we are all thinking that interest rates will pause or go down. What happens if interest rates go up? So I wouldn't put all my money into equity now. If equity SGP over 12 months, if it is long debt, I'll put my money now, or I'll repay my housing loan.
Okay, repay a housing loan definitely makes onto the top of the strategy suggested by you, Mr. Subramaniam. But when interest rates were near to the trough levels when back in COVID-19, wherein that was just 4 to 5% where you were getting the loans at, and we have seen a lot of boom in the consumption on the back of that. And since then, the interest rates were on the rise. But now that they are at the peak, and the Fed dot plot suggests that not this year, but maybe next year onwards, they could be thinking at lowering the interest rate. So, Mr. Subramaniam, if somebody is going to take a loan on a variable interest rates or for a long term, doesn't it make sense to like wait for some more time maybe and then have a loan wherein a large amount of money that is taken on loan could have an impact with maybe a 25 to 50 basis points as well?
Actually, no, because somebody who is young like you takes a 30-year loan, things are going to change. After 6, 8 months, maybe interest rates will come down, and after 3 years, interest rates will go up again. So it doesn't really matter if you're taking a long-term view. I mean, a housing loan is a 20-year or a 30-year kind of view. So that doesn't matter. My take is very different. My take is, if you've got a short-term view of your money, put your money in debt. You might make more money than in equity over a 3-year period. But interest rates come down, you will make capital gains. Will you make money in equity? Yes, but in equity you need a 6, 7 year kind of a time frame, because I wouldn't want to guess what will happen in equity over a 2-year period. Housing loan doesn't really matter. Go and commit to it now, as when the interest rates go down, you will anyway benefit with a lower EMI. I don't think interest rate can go up from here, at least for the housing loan person. So yeah, if you want a house and you can afford the EMI, go and take it. Don't wait for too long, because then housing prices could go up. You don't know. Everything does not happen at the same time. If housing prices go up and interest rates are low, but still your outflow could be higher.
Surely taking your point. But Mr. Subramaniam, we have touched upon the equity as well as the debt side. But other than that, you're also suggesting to like repay your debt as soon as possible. But what about the other asset classes, maybe gold? What's your take on that? Because with the recent rise in the gold prices, a lot of investors were feeling that maybe they must have missed the bus out there in terms of making an investments. But with the rise in the dollar index, we are seeing that the gold prices are drifting lower. But it still remains to be at the elevated levels. Now that the interest rates are expected to be coming lower, the inflation is expected to cool down a bit. Doesn't still makes a sense to go and invest in gold, as well as going ahead? What's the outlook on gold investments for a longer term?
See, people are forgetting two big reasons for gold to peak. One was the COVID crisis, and one was the Ukraine war, right? So if something like that happens, gold would peak again. But gold is not a great hedge against inflation. Gold gives you the volatility of equity and the return of debt. It's not a great asset class to be in. So a small percentage, maybe 5% of your total portfolio in the sovereign gold bonds makes sense for you to accumulate gold over a period of time. But other than that, no, because you're not going to buy. If you're going to trade in gold, then maybe a gold ETF. Right now, I wouldn't do anything in gold. I mean, gold does not give you a hedge against inflation. Sometimes you feel it does. But yes, if the dollar were to weaken, gold price would go up. But if the dollar were to strengthen, the gold price won't go up. So no, gold, even if gold were to be part of your portfolio through a multi-asset fund or something, leave it to the fund manager to decide how much of gold. Uh, Personally, gold, no. Gold goes up when there is some big crisis. So yes, if there's some big crisis, some war or something like that, yes. So if you leave out the COVID and Ukraine peaking of gold, gold is not given a good return. And we don't sell gold when gold goes up. So the purpose is lost, right?
Thank you so much, Mr. Subramaniam, for discussing all those factors that are play or could be at play going ahead, and how should investors place themselves at this point in time when there is expectation that interest rates may be nearing those peaks. But hang on with us, because we are now slipping into a short break. But as we come right back, we'll